What in the world is happening on Wall Street?
This market is as volatile as you'll ever see.
This could be the most serious recession in decades.
Imagine waking up one morning, checking your investments and realizing that everything you owned, like your property and savings, has vanished because the company that you trusted and invested into lied to you. So here's the question. How do you make sure this never happens to you? How do you know if a company is actually financially good or just faking it? The answer is to read the balance sheet. It tells you whether a business is stable or drowning, and most importantly, whether you should trust them with your money or not. Most people think that reading a balance sheet is difficult. A balance sheet is like a school report card, but instead of showing marks, it shows a company's financial health. Most importantly, the balance sheet reveals what the company owns and what it owes. And these owns and owes are divided into three parts. Assets, everything that the company owns. Liabilities, everything that the company owes. And equity, the value that belongs to shareholders. Let's start with understanding assets of any company. Anything a company can sell or use to make money is an asset. For example, you own a small juice shop. What do you need to run this business? You need a blender, fruits, a fridge, a cash register, and of course, some money in hand to buy your supplies. All these things that help your business function and make money for you are called assets. We can split them into two types. Short-term assets. These are things that can be turned into cash quickly, like money in the bank, inventory, or even payments a company is waiting to receive from its customers. And long-term assets, these are things that a company holds on to for a while. Assets are not just things a company owns, they tell us how financially strong a business is. Let's talk about the other side of the story, liabilities. In easy words, if assets are what a company owns, liability is what a company owes. Basically, liabilities are the bills, loans, debts that need to be paid out to somebody. Liabilities are also divided into two types, current or short-term liabilities. These are the bills that cannot be ignored. Just like your monthly rent or credit card dues, companies have their own short-term expenses which need to be cleared within a year. And the second is the non-current or long-term liabilities. These are the big long-term financial commitments, the kind that takes years to pay off. Now let's understand equity. Equity is what's left off after paying all your debts and liabilities. It's the real worth of the company that actually belongs to the owners or shareholders. Now, as we know what are assets, what are liabilities, and what are equities, it's time to learn to read the balance sheet. So, let's learn how to read a balance sheet like an investor. Well, don't worry, it's not rocket science. You just need to check a few key things and you'll get a pretty good idea. First, look at the current ratio. This tells you whether the company can handle its short-term expenses. The formula is really simple. Current assets divided by current liabilities. If the ratio is above 1, great. It means the company has enough cash and short-term assets to cover its immediate bills. But if it's below 1, that's a red flag. Now, let's talk about debt to equity ratio. This one shows how much a company depends on borrowed money. The formula again is very simple. Total debt divided by shareholders' equity. If the debt number is too high, it means the company is running mostly on loans. On the other hand, if the ratio is low, it means the company is financially stable and not overly dependent on debt. The bottom line, a good company has a current ratio above 1 and a manageable debt to equity ratio. Smart investors always check these numbers before putting in their hard-earned money. Now, the next thing to check in the balance sheet is ROE, meaning return on equity. This basically tells you how much profit a company is making from the money that investors have actually put into it. The formula is simple. Net profit income divided by shareholders' equity. The higher the ROE, the better. Now, one of the most important things the balance sheet tells us is net worth growth. This is where you check if the company's equity is increasing every year. Because at the end of the day, a company that keeps growing its net worth is a company that's building value for its investors. You just need to check a few things on the balance sheet. High debt levels, low cash reserves, declining assets, rising liabilities, and the ultimate red flag is the negative shareholder equity. That's where a company owes more than it owns. Smart investors don't just follow the hype. They always check their numbers first. If you found this helpful, drop a like, hit that subscribe button, and let me know in the comments which company's balance sheet you want me to break down next. So see you in the next one. Until then, invest smart, stay sharp, and see you soon.